Are you self-employed and feeling stuck or overwhelmed trying to secure a home loan? Well, I should know. I'm self-employed as well. So today's video, I'm going to talk about bank statement loans, how they can be a game changer if you're self-employed, you have issues with traditional financing, and how they can help you buy a home or refinance the home you already have. So let's get into it. Bank statement loans are a focus of my practice. I've helped several self-employed folks just like you get approved for a home loan when they couldn't otherwise buy one. Okay, so what is the problem? Basically, let's look at traditional loans versus self-employed and bank statement loans. So why do we need bank statement loans in the first place? Well, basically it comes down to income documentation. Because after Dodd-Frank in the wake of the 2008 and the Great Recession and everything, so everything became about ability to repay. And really, those stated income loans that were back in the 2000s that caused the crash, they were meant for self-employed individuals because they tried to help self-employed folks out by saying, well, I know that you make money because you've been in business for a while, so let's do a stated income program. And unfortunately, those stated income programs were abused, and that's how we ended up with the Great Recession. So I digress. So basically, that's kind of how it started. So after Dodd-Frank, everything became about ability to repay. And they decided that using tax returns and net cash flow, the SAM method, was the way to do it. And it's basically your net income, minus your, after you've wrote everything off, is your net income. You can add some add backs like depreciation and things like that. But ultimately, you got to basically pay taxes on your income. Of course, it makes sense because, who's getting your tax returns? The IRS. It's a federal government agency. So, and who runs Fannie Mae, Freddie Mac, NFHA, VA? They're all federal rerun things. I'm sure those guys kind of got together and said, hey, how about we make, them pay their taxes? Otherwise we can't insure their loans. That's kind of what I believe, happened in the background. But ultimately, those rules were changed. So the ability to repay rules meant that you, as an income, if you're traditional income, you had to actually show it. So self-employed individuals, in the wake of Dodd-Frank, they face some challenges. They have to document their income, or they have to pay more in taxes in order to qualify for the mortgage. So rather than using, the tax law available write-offs in order to, pay less in taxes. So kind of that's the dilemma that they're in. I can either show a bunch of income and get whacked in taxes, but I can get my mortgage, or I follow the plan of my business plan and write off what I can to maximize my net income and profitability, or not get a mortgage. So that's kind of the dilemma that they are in. So that's how bank statement loans kind of filled that void. So they allowed an alternative form of documentation, as they call it. It's bank statement documentation of your income to satisfy the ability to repay rules or ATL rules. Okay, so what are bank statement loans exactly? And how do they differ from traditional? So again, it's essentially tax return versus bank statements. And I can use personal bank statements, business bank statements. I look at the last 12 months or 24 months. And how they differ is I look at net deposits. So that's what we look at. We look at what money is coming in. So it's a pretty much makes sense viewpoint of income documentation. I know that your business is making money, and at the end of each month that you're making money, I can kind of do an average of what your income is, and then I can kind of basically apply an expense factor. It starts off at 50%, but if your CPA says it's less, and it's a pretty simple way to calculate it. It's like all my inflows of my bank statements, my business bank statements, minus an expense factor is my income. And there's certain qualifying deposits, that we look at, and the way we document it is we get all your documents in, we get all those bank statements in. The more bank statements we have, generally better your interest rates will be. And so we ask for 24 months of your business bank statements or your personal bank statements of your Schedule C in order to see what your inflows are, and that's how we calculate your income. It allows some great flexibility. To use the overall cash flow of your business versus taxable income, on your tax return. So that's definitely a huge benefit. So you can qualify for more house with a bank statement loan than you could with a traditional, a traditional mortgage that you have to use your tax returns. So you have a potential for larger loan amounts and larger purchase prices just based on your revenue versus just the tax returns. Okay, so what are the drawbacks of a bank statement loan? And there are some. Basically, not everyone offers them. So for me, I'm a broker, so when you talk to me, I have multiple investors that are out there. They're called non-QM, non-qualified mortgage. So that's the sphere of the type of loans that are out there. And I did some videos on my channel about non-QM loans in general. But basically, bank statement loans are a major portion of the non-QM space in order to do that. So that being said, one of the drawbacks of a bank statement loan is the interest rates are higher. So for alternative documentation, yes, it's easier to qualify, but then the lenders charge a premium for that service. So your interest rates are about half a point or more higher, depending on the investor, in day-to-day than they are for traditional financing loans. I swear there are potential drawbacks, and there's some things to consider. First and foremost is interest rate. Rates are higher on these guys. There's no way around it. So for alternative documentation versus traditional conventional loans, it's about a full point interest rate higher. So kind of good rule of thumb. Whatever conforming rates are, just add 1% to it, and that's about what a bank statement loan will be. But again, it allows you to qualify at all, whereas before, if you wrote everything off, you didn't qualify for anything. This allows you to qualify for a loan, if not more of a loan than you could with traditional conventional financing. And of course, not all lenders offer them. So if you're dead set on using your local bank, they're not going to have bank statement loans, guys. They do plain Jane vanilla loans. That's about it. That's why if you want to come to a mortgage broker like me, I have multiple investors. I have certain investors that specialize in non-QM, and that's what kind of loan it is. It's a non-QM loan or a non-qualified mortgage loan. And they're the ones who do those loans. So you come to me, we can place you in those bank statement loans. Also, if you don't run things through the bank, if you're a cash business, this is not for you. So you have to have good business bank statements that you can send and actually document that you're putting all the money in the bank and then you take all the money out. So if you like to keep things off the books or you like to run it with cash business, then a bank statement loan is not going to work for you guys. Bank statement loans are part of my practice. We do several of them every month, and we help self-employed folks who would otherwise not qualify buy a home or refinance or buy an investment property, something of that nature, because of their self-employed nature. They're business owners or entrepreneurs. They write everything off because they can, because that's the law. So we allow those folks who follow the tax law in order to buy a home and basically cash flow their business. Okay, so what are some tips about getting a bank statement loan? And again, being organized, having business bank statements, making sure all your income is being accounted for and all the deposits are accounted for. And again, if you have alternative forms of income or things outside of your bank statements, it's not going to work. So you definitely have to make sure that you're documenting your income and that you're using your business bank statement and running everything through the business, and you're not just operating as a cash business. It has to be an actual real life business. Also, it's got to be more than 2 years in existence, and sometimes more depending on the investor. So if you just started, last year, you're gonna have to wait a couple years in order to have documentable income. If they want to see that 12-month, 24-month, sometimes 3 years, the more the better. Because the more that they can see that there's a consistent flow of cash, the better interest rates and better terms you can get. Okay, so are there any alternatives to bank statement loans? Well, yes. Depending if you're buying investment property, there's a DSCR loans, and I just did the video just recently about DSCR loans. There are another type of non-QM loan, but they're mainly for investors only, and then it has a lot of pros and cons of those. So basically, the major types of non-QM loans that are being written in 2023 are bank statement and as well as the DSCR. So go ahead and check out that video. Okay, so bank statement loans are a fantastic option for self-employed individuals who can't qualify for traditional financing. If you have any questions about your own bank statement loan, definitely go in and book a call with me. We'll kind of go over your situation and figure out what you qualify for. So you too, once you watch this video right here.